So this graph, it shows the total use of the classic indicator-based strategies. You know, the ones built around moving averages, MACD, RSI, price action, and all that old school stuff. Now, this second line. That's smart money concepts. It represents the number of traders using that style of trading. And right here, you can see the shift. A spike in SMC and a drop in the old methods. What does that mean? Simple. Traders are switching sides. Alright, this is insane. Everybody's talking about it. We are witnessing the end of the war between retail traders and smart money. Retail traders are no longer fighting institutions. They are finally trading with them. But behind the hype, there's something deeper. Something powerful, almost too powerful. Because once you understand how the real money moves, how banks, institutions, and market makers manipulate price to trap retail traders, you will never look at the chart the same way again. In this video, we are breaking it all down, from liquidity traps to order blocks, fair value gaps, market structure, and more. Now, before we go any deeper, I'm gonna say something, and I'm gonna say it twice so you don't forget it. Here you go. Smart money concepts are not new. Alright, let me say it again. Smart money concepts are not new. You've probably seen this explosion online, right? Everyone's suddenly an expert, everyone's got an SMC course, but here's the crazy thing. This method is old. It's even older than technical and fundamental analysis. Tracing all the way back to Richard Wyckoff's work in the 1930s when he talked about how institutions move markets. He was one of the earliest minds to decode that in the papers that he published. He called it the composite man. But in reality, he was talking about institutions, smart money, the whales. Alright, here's the real reason smart money concepts exist. It helps you predict reversals or continuations. That's the whole game. And to actually read that game, you need to understand three key ideas: liquidity, supply and demand, and market structure. Alright, let's start with the one that smart money cares about the most: liquidity. Big institutions don't play with $1,000 account. They are moving hundreds of millions, if not billions. But they can't just press buy like you do on your phone. They need someone on the other side of the trade that is ready to fill in their order. And that someone is you. Imagine this. You open a $10,000 buy trade and set a 10% stop loss. If the market hits your stop loss, you'll automatically sell $1,000 to avoid losing more. That's the idea behind stop loss. But guess who's buying that $1,000 you just panic sold? That's right, the big players, the smart money. Now, zoom out. Let's say the whole market is bullish. Everyone's buying, but institutions need people to sell to them to keep on buying. And when no one is selling, they create sellers. How? They push the price down. Not because they think it's going down long term, but because they want to trigger your stop loss, force you to sell and feed their orders. With stop loss you think you're protecting yourself, but to them your stop is just free liquidity. They will drag price just low enough to collect all that juicy selling, then boom, the real move begins. Once you start seeing that pattern, you'll never look at price action the same again. You'll stop following the herd and start riding with the whales. Now let's go deeper, because not all liquidity is the same. There are few places where smart money knows the cash is hiding and they hunt it like sharks. First, equal highs and equal lows. Retail traders see this and think of support and resistance. a safe zone. But smart money, they see it as liquidity buffet. Every time price touches that same level, more stop losses pile up behind it. And guess what stops are? Orders, money, fuel for the whales. Second, we have trendline liquidity. Everyone loves a good trendline. Retail traders draw it, trust it, and bet the farm on it. But what happens when price dips just under that line? Panic, fear, trap traders everywhere. Yeah, smart money just triggered a flood of sell orders, only to reverse it right after. And that's the trick. Smart money doesn't follow the trend. They move the market towards where liquidity lives. And once they've collected enough stop losses and flipped the herd the wrong way, they turn the whole thing around. Alright, you've wrapped your head around liquidity. Now, let's talk about supply and demand, because this is where things start to click. This is where smart money leaves footprints. Think of the market like a giant marketplace. When demand is high, but supply is low, of course, price goes up. And when supply is high, but demand drops, price goes down. It's not just theory, it's how every candle on your chart moves. But in trading, the products aren't shoes or phones. They are buy and sell orders. And institutions, they are not just placing random orders. They are strategically loading up at key zones. The first one is demand zones. A demand zone is an area where smart money previously bought in heavy. It's where price exploded upward, and when it comes back down to that zone, they are often waiting there again, like sharks ready to snap up more. You will see it on the chart. Price goes up from a level like this, comes back, and rockets again. So here, that's where you want to go long and buy. You are literally riding the whales. The second zone is the supply zones. It's where price collapses. Now, flip the script. The supply zone is where price previously dumped hard. That means smart money sold heavily from that level. And if price climbs up, they are probably waiting to sell again. And you will notice the pattern. Price drops from this level, pulls back, and crashes again. That's a good opportunity for you to short sell. But here's where it gets juicy. Order blocks and fair value gaps. These are the real clues left behind by institutions. Let's start with the order block. It's the last place smart money accumulated or distributed orders, right before a big move like this. Think of it as the final bullish candle before a big dump or the final bearish candle before a major rally. That's the order block, the origin of the move. Now, right next to it, you will often spot a fair value gap. This shows up when price moves so aggressively it skips levels, leaving a visible imbalance. Usually it's the gap between candle wicks, like this candle's high and this candle's low, candle 1 and candle 3, with candle 2 showing a big price move. That imbalance is where smart money didn't get all their orders filled, so price comes back to rebalance. Here's how it all connects. You are watching price hover in a boring range like this. Here buyers and sellers are fighting it out. This is fair market value. Suddenly you get a breakout, one big candle. That's not retail, that's smart money making their move. Now zoom in. This final candle before the breakout, that's your order block. And the price gap created by the explosion, that's your fair value gap. And once price returns to that zone, smart money is often waiting to finish the job. So, the cycle. First they load up, then they explode price to create imbalance, then they come back to collect the rest of their orders, then if the structure agrees, they do it all over again. So supply and demand isn't just about more buyers or sellers. It's about understanding where smart money is entering, where they are leaving gaps, and how they build positions through absorption. Because every aggressive move you see was planned and engineered. And if you're watching the right zones, you can follow the footprints. Now we reach the last and the most important part, the market structure. Yeah, the market structure is like the DNA of price action. It teaches you to read the chart like a story. Basically, there's two main structures. A bullish structure, simply higher highs and higher lows, and the second one is the bearish structure, composed of lower highs and lower lows. SMC traders don't just look for patterns. They follow structure shifts, especially breaks of structure and change of character. For example, if the market is making higher highs and higher lows, this is a classic bullish structure. Each dip is a buying opportunity. So if you're trading SMC, you'd be watching the higher low zones for order blocks or liquidity grabs. Here's the rule: in a bullish structure, wait for pullback into order block near a higher low for an entry. Now, for bearish market structure, the same idea flipped. Here price keep failing to break previous highs and make new lows. That's bearish, and smart money is selling from lower high zones, and so you should. Now let's say that we have this bearish structure, and all of a sudden price makes a higher high for the first time, breaking this level. That's your change of character, and that's one of the key moments in SMC. After that, if you see a higher low, you should wait to confirm it wasn't a fake out. Here you can long on the retest of this zone that caused the change of character. With the help of a order block and fair value gap, if this is confirmed, this means we entered a bullish structure. So, change of character is a signal to prepare for a reversal. Next, the shift or break of structure. This is the second most important concept in SMC. A break of structure is like the market flipping sides. Let's say the price was going down, lower highs and lower lows. Suddenly, price breaks a previous lower high. Boom, that's a BOS to the upside, and this means smart money may be switching to bullish. Same in reverse. If we are in an uptrend and price breaks a higher low, this indicates a break of structure to the downside. Alright, that's the foundation of smart money concepts. The core principles are liquidity, supply and demand, order blocks, and fair value gaps. You've now got the map, and all that's left is to apply it. So start testing this concept on different markets, watch how price react, and you will start to see the pattern everywhere. The more you practice, the clearer it gets. This is your ground zero. Now go trade like smart money.